moderator for today, and I'm delighted to be here with you and our panelists. But before we begin, I'd like to go over some housekeeping items. The event today will be conducted in English. It will be recorded, and a replay link will be sent to all registered attendees soon after the live presentation. To protect your privacy, HSBC will not record any client images, voices, or personal information during this event. And following today's feature presentation, we will facilitate a roundtable discussion with our panelists through the Q&A feature that's located at the bottom of your screen. Simply type in your questions and submit them, and we'd be happy to answer your questions. Now to begin, tax season is just around the corner, and we have partnered with EY to share insights and best practices to help you navigate this year's tax season. I have the pleasure of introducing three special guests to share their insights and expertise with us and overview key tax considerations relevant to you and your family's financial success. So joining me today, I introduce Ken Kyriakou. Ken is a tax partner in EY's private services. He's been in the area of taxation for over 23 years, focused on tax compliance, consulting, and planning for private family businesses. I further have the pleasure of introducing Wesley Isaacs. Wesley's a partner of EY Law and has over 12 years of experience providing tax and estate planning advice to high net worth individuals, business owners, executives, corporations, and trusts. And lastly, we have Andrew Stevens. Andrew is a senior manager at EY with over 11 years of experience with compliance, planning, structuring, and dispute resolution for high net worth individuals and international assignees. We want to welcome Ken, Wesley, and Andrew. Thank you very much for being here with us today. And with that, in our featured presentation, Ken, I turn it over to you.
Thanks, Lisa. Thanks for that warm introduction. And hi, everyone. We're very thankful that we can present to you personal tax planning best practices. So let's move to the agenda. We're going to go through some of the personal tax planning best practices. We'll also get into succession and estate planning and cover some 2021 personal tax considerations for you to think about. We have sprinkled throughout these three agenda items not only Canadian domestic issues, but also cross-border as well. When it comes to personal tax planning, the first thing that we tell all clients is really just to kind of understand how the personal tax rates work. And I've summarized here what the highest marginal rate is in each province. And you know, this is a good starting point, because when it comes to tax planning, it's important to understand where you are in the bracket. And I haven't put all the different brackets here. Every province has their own brackets. And that's important as well, because if you do have a certain family member that's making, you know, a certain amount of money, but you're not at the top rate, that can allow for some tax planning. Going to the next slide, and I just did this only for Ontario, but every province, you should also understand what the different tax rates are for the different types of income. And when you look at whether it's regular income, interest income, or the capital gains rate or dividends, there are different tax rates, and that's again important to know when it comes to the planning. I mentioned the high marginal rates before, so the income threshold in Ontario is $221,000 for, and that's when you become taxed at the high rate of 53%. So when you go to the next slide, because you have various provinces and various high marginal tax rates between 44 and 54, it's really important to then look at where do you fit in with respect to these rates, and do you have family members in lower marginal rates, and is there something that you can do to help with respect to tax planning. There have been rules that have come out over the years. Before, it used to be a kiddie tax. Now we call it tax on split income, which is TOSI. That really stopped a lot of the planning involved with paying family members and having them receive income. But the safest way is to have the higher income earning partner or spouse pay all the living expenses, and having the other family members that are making less money at lower marginal rates for them to not pay for living expenses and to invest. Obviously, RSPs, there's split pension income, and obviously using your TFSAs. Next slide, please. There is a tax planning available with respect to also being able to move money from one family member to another to invest by using prescribed rate loans. Right now, prescribed rate for these loans is 1%. That may change as interest rates increase, so we're still waiting to see if there will be any change on that. But this is a good way to be able to have somebody that is earning at a lower rate to loan that money at the prescribed rate, which is currently at 1%, and have that individual invest into and make investments with that loan. As long as you pay the interest, it must be paid by January 30th of the following year, and this way you can be able to move some of that investment income to someone else in the family. You can also do these prescribed rate loans with trusts as well, and we'll talk a little bit more about trusts in a minute. The other thing just to note, and I know that a lot of people ask us questions all the time about, when I'm investing, how do I invest that into companies or start my own business? And there is again a tax opportunity if you do invest in we call it CCPC. It's Canadian Controlled Private Corporation, and if that Canadian Controlled Private Corporation meets the definition of a qualified small business corp, you can use and you're able to use your capital gains exemption to be able to reduce that gain when you sell those shares. So that's only available to you personally. So if you are going to invest in a Canadian private corporation or start your own company, owning those shares directly is very important to be able to utilize this capital gain exemption. That capital gain exemption is best for you if you are investing through a holding company or an investment company. Keep an eye on to make sure that the shares qualify. We're not going to get into those rules today. And you also have to make sure that you don't have any other losses in the past that grind down this exemption. Right now, for 2022, the capital gains exemption is $913,730. So it's almost $1 million of capital gains that you can shelter by using this. It may, or most cases, it will give an eye on that. So moving along, why don't I turn it over to Andrew, and he's going to talk a little bit about some of the cross-border issues before we get into succession planning.
Well, thanks a lot, Ken. So Ken just gave some great examples of some best practices that you can use from a purely Canadian domestic process or perspective to improve your tax position. What I'm going to do now is I'm going to almost kind of let you guys in on a few secrets, a few tricks of the trade on what we do from a cross-border perspective when we get a new client in the door. And so what we'll do is one of the first things is we'll recommend doing a health check on their financial position. And in the health check, what we're doing is we're looking for red flags, things that if a client is invested in that have a cross-border element may create a situation where they're paying more tax than they need to, and they result in some easy wins, some things that can happen that can very quickly and easily reduce the taxes that they're paying. So the first one that comes up quite a bit, and it's a very easy one for people on the call to take a look at and say, maybe this is something that I need to look at, is putting US or at least non-Canadian dividend stocks in a registered account like a TFSA account or an RRSP account. And the reason that that's something that leads to a less optimal result is, I'll just take an example. Let's say that you have $50,000 worth of ExxonMobil stock, and you put that $50,000 worth of ExxonMobil into your TFSA. If you get a dividend of $10,000 in your TFSA account, the first thing that you'll see is you'll see non-resident withholding tax being taken off $1,500, and then the net will be deposited into your TFSA. So what is that non-resident withholding? Well, it's money that goes to the IRS because they have the first crack, being a U.S. company, at taxing that income, and that's the treaty rate that would apply to you for the dividends that you've earned. So what you've effectively done is you've taken your TFSA, which is supposed to be tax-free, but you've ended up paying tax in that account. Now, if that was happening outside of your registered account in a non-registered position, you would be able to credit that tax. You could take that against the Canadian taxes that you're otherwise paying on your investment income, but because it's in a registered account, that tax is lost and you can't get any value out of it. So it leads you to an easy suboptimal position to correct. The second item that also comes up quite a bit with our clients is we start looking through their assets to look for anything with LLC at the end of it. LLCs are an absolutely fantastic structure in the US. They have a lot of benefits. But most of those benefits come from the fact that for US purposes, an LLC is considered what we refer to as a flow-through. As the LLC earns money, you're deemed to have earned it personally and in proportion to your share that you own in the LLC. And therefore, it's as if you personally, but you get the benefits of anonymity, of asset protection, liability protection, and even some positive tax attributes. Now, from a Canadian perspective, the problem is an LLC is considered to be a regular corporation. It's a blocker, and therefore you don't pay any income tax, and you don't pick up any money in income until the LLC makes a distribution to you, which could very well be in a subsequent year. Because you're paying tax in 2 different years, you don't have the ability to integrate your foreign tax credits, and you can very easily end up in a situation of double tax. So moving on to the third situation, we see a lot of, it's not going to be a surprise to anyone on the call, but we see a lot of people in Canada that have vacation properties in the United States. What happens in that particular case is it's often quite common to say, well, while I'm not at my vacation property, I'm going to rent it out and I'm going to earn some rental income to help cover my costs. What can really be a bit of a pitfall for people there is if they are not filing a US tax return, where they make an election to claim the income that they're earning on their condo or on their vacation property as business income. Because if not, the default treatment that the IRS has on that income is that it's passive investment income. Gross income is taxed at a flat rate of 30%. So that means even if you have expenses, you have condo fees, you have mortgage interest, all sorts of things that would normally be deducted from the rental income you're earning, from the IRS's perspective, all they care about is the gross rent that you receive multiplied by 30% equals your tax liability. So it's very important to timely file a return with the right election on it. So at this point, I'm going to turn it over to, I believe this is now Wes, to talk about succession and estate planning.
Thanks, Andrew. Yeah, so as Andrew just mentioned, I'm going to talk about succession and estate planning, and specifically through the lens of how we can try and manage and minimize taxes when transferring your wealth to your heirs. You've built up a nest egg, it's that you want to try to leave as much as possible to the next generation, and frankly, as little as possible to the CRA. And so that can mean looking at strategies to reduce taxes faced by your estate when you pass away. It could also just be deferring taxes as much as possible, delaying them. So maybe tax isn't payable when you pass away, but when your spouse passes away, or even better, delaying it until the next generation. We also look at ways at just fixing your estate tax liability today. So you can plan appropriately, have some certainty, make sure that you're going to have enough liquidity in your estate so your executors don't have to start selling off major assets to pay CRA instead of your beneficiaries. And as part of that, we often look at, maybe insurance can be a component of that. It can be a very tax efficient way to get liquidity into your estate to pay those tax liabilities when you pass away. And so today I'm going to focus on a planning strategy that incorporates all of these, but really focus on numbers 2 and 3, and that's the estate freeze. I guess an estate freeze, I'll get into the details of it, but it's a structure that really incorporates a lot of different tools, or at least comes into an estate plan that incorporates a lot of different tools. It usually involves family trust planning. We also try to make sure that if you do an estate freeze, we visit proper will planning, something we call dual wills. Also maybe holding assets in joint tenancy to avoid probate, which I'll discuss in a bit more detail in just a second. Like I just said, insurance can be an important part of that. And also updating any shareholders agreements or sometimes entering into them. And just to touch on that for a second, I find that shareholders agreements are often overlooked as part of an estate plan. And it's not just in the context of, say, if you have an operating business and you want a proper shareholders agreement. Shareholders agreements can be just as important if you have a family investment company where your family members or a family trust hold shares of that company, and making sure that once we've put a plan in place, that company is set up for success in the long run. After you're gone, it can still be run and continue returning investments for your family even after you're gone. But if we go to the next slide, before I get into the details of that, I just want to lay the groundwork and give a basic overview of the taxes that are triggered on death in Canada. And so for tax purposes, when someone passes away, they're considered to have sold all of their assets at fair market value, which basically means that, to the extent that there are any accrued gains on those assets, to the extent that the value went up from the date they were acquired, well, then capital gains taxes are going to be payable. There are some exceptions. So, for example, property left to a spouse or a qualifying spousal trust, could get rollover treatment. Your home might be sheltered by the principal residence exemption, and certain registered plans like RSPs, RESPs might get rollover treatment to another plan when you pass away. But for the most part, assuming the deceased is in the top marginal tax rate, and say in Ontario, they're going to pay about 27% tax on those capital gains when they pass away. In addition to that element of it, there are also probate fees. And probate is something that I think a lot of people are aware of, but not many of us are familiar enough with it to know exactly what it is. And probate is basically the process by which the courts will prove or validate a will. And it also gives your executors the authority to deal with your estate. And so, for example, you're typically going to need probate to probate a will when you have assets like a bank account or real estate. For example, a bank typically won't let your executors deal with your bank account once you've passed away unless they see a probated will. And there's a fee for that. We call it probate fees. In Ontario, it's technically called the estate administration tax, and that's about 1.5% of the probatable assets. I think in BC, the rate is 1.4%. But there is a very common planning technique in Ontario and BC to use what's called multiple wills in order to avoid probate on at least some of your assets. So multiple wills or dual wills, and this basically means that you have one will for your probate assets and one will for your non-probate assets, and so that only those assets that need probate to be administered are going to be subject to those probate fees. So, like I said, bank accounts, maybe real estate, but typically things like private company shares, your personal possessions, they don't require probate, and so you can avoid that 1.5% tax on those assets. Another common technique to try to avoid probate is holding assets in joint tenancy. That can also be very effective, but only if it's done the right way. And just as a word of caution, I've often seen advisors suggest that any assets put into into joint tenancy can be excluded automatically from probate. And that's not always the case, particularly where you put your kids on title, say in the case of a bank account, or in many cases, that's not enough. You still need dual wills as well, even if you have assets in joint tenancy. So just something to keep in mind, that joint tenancy as a probate or avoiding probate tool could be effective, but it might not be enough. You might also have to revisit your wills to make sure that it's effective. Right, so the estate freeze. The estate freeze is a popular strategy to try to reduce the taxes when you pass away, both income taxes and probate fees. And typically, this is going to be part of an estate plan when someone is a bit older, maybe they're approaching retirement age, maybe a bit younger, and they own investments that either have large accrued gains, maybe not, but they're likely substantially in value in the future. Things like shares of a private company or even just an investment portfolio. And the way it works franchisor is going to transfer those assets, say the investment portfolio, to a new corporation that they set up. And as payment, they're going to take back fixed value preferred shares in this company. So shares that have a fixed fair market value equal to the value of the investment they want to freeze today. And what that really caps or freezes their ownership value. And as a result, it's going to cap their future tax liability when away, because if the value of what they own doesn't go up, then the taxes associated with that don't go up. And then immediately after that freeze transaction, that company that we just created is going to issue new common shares, typically either to the freezer's kids or to a family trust. And so now what you've done is you've basically given the future growth, the future value of that asset to the next generation. And so all the tax liability, that growth, is no longer going to be borne by your estate, because when you passed away, it's held by, let's say, the family trust. If we go to the next slide, yeah. So just to give a more concrete example to see how this works, let's assume we've got here Mr. A, who has an investment portfolio. It's worth $10 million today. The cost of the investments in the portfolio total $5 million. And let's assume he's let's say 65 years old, no spouse, and 2 adult children, and he lives in Ontario. And also assume that in this case, he hasn't updated his will in a while, and so it's out of date, and there's no probate planning. So if we go to the next slide. So if Mr. A doesn't do any kind of tax or estate planning, his estate is going to have a pretty big tax hit when he passes away. So let's fast forward 20 years. He lives to age 85, at which point his investments have increased in value to 25 million. So that is a $20 million capital gain that's now subject to capital gains taxes at about 27%. So total income taxes of about $5.35 million. But in addition to that, because he didn't have proper wills in place, there are also going to be probate fees of about another $375,000. So that's total taxes of about $5.75 million on this $25 million asset. But now, if we go to the next example, let's say that Mr. A does an estate freeze. So to do that, he'd take his portfolio today and he'd roll it into a new company that we set up. We'll call it ACO. And in exchange for that asset, he's going to take back these freeze shares, those fixed value preferred shares, and they have a fixed fair market value of 10 million for the portfolio. And his cost in those shares is going to be the same as the underlying portfolio, also $5 million. And then after he does that freeze transaction, we're going to set up a family trust for his kids, his 2 adult children. And that trust is going to subscribe for new common shares of that company ACO, so that every dollar of future growth in that investment portfolio is now owned, at least indirectly, by the trust. Everything above $10 million belongs now to the trust. And let's assume also that Mr. A now executes those dual wills so that he has some probate planning in place, and his secondary will is usually what it's called, will govern his non-probate assets like his shares of ACO. So if we go then to the next, here we go. So now you can see that just with a little bit of estate and tax planning, there are a lot of potential savings. So in this case, the fair market value of Mr. A's shares of ACO, they never go up, right? They're going to stay at the original $10 million. And the tax on that is capped at around $1.34 million. And because now Mr. A did put in place dual wills, he did that probate planning, his shares of ACO aren't subject to probate at all. And so all told, he's only paying roughly $1.34 million of tax, and compared to the first scenario, he saved almost $4.25 million just by doing the estate freeze and updating his wills. And that's just one stage of planning. Often we can to slowly bring down that tax down over time, even further, but we'll get into that today. Just a little bit short. But if we can go to the next slide.
Well, actually, Wesley, I wanted to add, if I can, on the slide before.
Sure.
And you and I also are involved with a lot of planning when it comes to people, expecting the capital gains rate to increase. And right now, 50% of the gain is taxed in Canada. This is another way to potentially even trigger some tax at the capital gains rate if you think it's going to increase. I know every year there's always a lot of speculation that the capital gains rates will increase. But if you do this type of planning, you can actually trigger some of that capital gain to kind of crystallize that lower capital gains rate, if you suspect that it will increase.
That's a really good point, Ken. And without getting into too much detail just because of time, I do have clients who have assets with substantial accrued gains. And so a change in the capital gains tax rate would have a major effect on them. And so it has become almost annual planning for them. Well, they will intentionally basically do a similar kind of transaction each year and be able to wait and see if they want to trigger the gain or not. So they can say, okay, if the capital gains inclusion rate goes up, we'll trigger the taxes, and if not, we are basically in the same position that we were today. Great point. So as in the last example, when we do an estate freeze, we typically recommend that the future growth of the frozen company, those common shares, get parked in a family trust, rather than having your kids come in and subscribe for shares of the company directly, although both happen. But preference, at least my preference, is definitely towards a trust because it provides a lot more flexibility and protection over the long run, a lot of advantages. So for one, trusts are usually designed to be discretionary, which can really help in terms of being able to constantly monitor your family situation and needs. So it could be that distributions unequally each year, or maybe not at all. Maybe distributions aren't made to the next generation, and we set it up so that you can take back profits that are paid out to the trust if necessary, or it changes from year to year. Another major advantage is if you happen to be freezing rather than an investment portfolio, an active business, you might be able to use the trust to take advantage of the lifetime capital gains exemption for each of the beneficiaries, that exemption that Ken mentioned right at the top. And so that exemption is almost $900,000 of capital gains that a person can shelter when they sell shares of a Canadian-controlled private corporation that has an active business in Canada. And so let's say the trust had only just two beneficiaries, two kids of Mr. A were beneficiaries, and let's say instead of a portfolio, ACO had an active business in Canada. Well, that could be roughly 1.8 million in capital gains that is now tax-free on a future sale, right? And that's just in addition to any exemption that was actually claimed by Mr. himself. And another advantage of having a trust rather than having your kids come in directly is there could be an added layer of family law protection. So if, say, one of the beneficiaries was married and then it was getting divorced, if done right and you had the proper planning in place ahead of time with a trust, you might be able to protect some of the trust assets, so the shares of ACO, from a claim on a divorce. And I think the last perk of using a trust is that it can make the whole freeze reversible. As much as I hate to say it as a tax lawyer, tax isn't everything. And, sometimes life circumstances change and you want to be able to take back that equity if needed, right? You gave all that future growth to the next generation, or intended to, but, maybe circumstances change and you need to take somewhere else that allows you to do that. So just a few other considerations in the context of an estate freeze that I think is important to keep in mind. One is I've heard, again, like people, when they hear about estate freezes or they know a little bit about estate freezes, they think, oh no, I've got to give up control. I don't want to do this because I don't want to give up control of my assets or my company to my kids. And the truth is you don't need to do that. We always have a preference for structuring it so that voting control of the company remains with the freezor for as long as they want it. And similarly, we try to structure it in a way so that the freezor can also be the trustee of the trust, sometimes even the sole trustee, so that they control not only the company, but the trust. So what happens with the investments and what happens with distributions. And just, circling back to advantages of the trust, or even in estate freezes in general, if you structure it the right way, you might be able to income split with a spouse As Ken mentioned, the new tax on split income rules have really shut down the ability to income split with most family members, but there are structures that can be put in place still to income split with a spouse effectively in a lot of cases. And I think the last thing is just the nice thing about a trust, especially, and the freeze itself, is it allows for some creditor protection. Generally, shareholders are not liable for the debts of a corporation, so you get protection at the shareholder, and same beneficiaries are generally not liable for any debts of a trust. So there are added layers of creditor protection that you can get in addition to the tax benefits from. And so just a last set of considerations that I think are important to think about in the context of an estate freeze. One is just to reiterate that typically shares of a private corporation can avoid probate in Ontario. You have proper dual wills in place. And where it may have been the case that you would need probate, say, for an investment portfolio, you might not need probate, you likely wouldn't. So you've basically saved that 1.5% probate fee on the value of the assets that you've frozen. Another thing is that we have basically frozen the tax liability that the freezer is going to have to pay or their estate will have to pay when they pass away. And because of that certainty, it makes it a lot easier to plan for the taxes that are going to have to be paid on death. So you could look at your assets and decide what assets are going to be used to fund the liquidity or to fund the taxes on death. But it can also be an opportunity to start looking at insuring those liabilities. And insurance, especially insurance owned by a corporation, can be very, very tax efficient, especially when you know exactly the amount that you need to insure for. And also just another note of caution, because I've seen this tripped up before, you do want to be careful and don't assume that your beneficiaries can help cover any taxes that might be payable when you pass away. Unfortunately, the tax rules are written in such a way that if the beneficiaries pay for taxes of the estate or loan funds into the estate, it can undermine the ability to carry a lot of what's called the post-mortem tax planning that we like when you pass away, and post-mortem being tax planning for your estate. The last thing is be very aware of any non-resident beneficiaries or particularly U.S. persons who might be beneficiaries of the trust or shareholders of the company after you do an estate freeze. An estate freeze can trigger a lot of adverse tax consequences, particularly for U.S. persons, so U.S. citizens or green card holders. And I'm going to leave most of the U.S. considerations for Andrew. But if there are any U.S. citizen beneficiaries of a trust, and that trust owns shares of a Canadian corporation, it creates a lot of headaches. And so if you have U.S. people, it's just a good indicator to speak to your tax professional and raise it, because you don't want to accidentally put any of, if you've got, say, a kid in the States, you don't want to put them in a bad tax position unintentionally. And with that, I guess I'll turn it to Andrew, who's going to talk a little bit about some U.S. tax considerations and some personal tax planning considerations as well.
Well, thanks a lot, Wes. And basically what I'm going to be describing on the next few slides is that very unlike Canada, the U.S. system is a completely different ballgame when it comes to U.S. estate tax. You saw from what Wes was presenting that the main two things that you have to take a look at in Canada are managing any capital appreciation that you have in your estate, and then also managing the probate exposure that you have. Estate tax, and it's based purely on the fair market value of the assets that you have when you pass away. It's the reason that we have the Gates Foundation and the Carnegie Foundation and all these very generous foundations in the US, is because estate tax is levied on the fair market value of the assets that you have on death, not on the up to 40%. So to put that in perspective, if you have $1 billion, which we all wish we had, and you were to die as a US citizen, or as a U.S. resident for estate tax purposes, of that billion, have estate tax of upwards of $400 million payable to the IRS. So it's a very significant bill, and it's the reason why there's so much charitable giving that occurs with big estates in the United States. Now, changing gears, why does that matter for us Canadians in the room, in the virtual room? Well, it's because US estate tax is still something that can potentially apply to Canadians. And this is something that's very much off the radar. And actually, if you don't mind, I wouldn't mind just going back to the last slide for a second, just to quickly list a couple of things. But for Canadians or for non-Americans, US situs property can still be subject to US estate tax. And US situs property, I've got some examples here on this one slide, but it can include, the big one is US real estate, so having a vacation property in the US. And it also can include, believe it or not, shares in US companies. And this is the case even if those securities are held at a Canadian broker. So you have a Canadian broker and you've bought Apple stock, you have US situs property, and it could potentially be subject to US estate tax. But it's not all doom and gloom. There are big exemptions, and we're going to get into those next. So we'll forge ahead here to the next slide, and I can start walking through. So essentially, there are exemptions that apply for US estate tax. If you're a non-resident alien in the United States and you're not living in a treaty country, it's a very small exemption. The exemption is $60,000 US that you're allowed to have as US situs property before estate tax kicks in. And after that, you're paying US estate tax on the fair market value of your US situs assets. Now, obviously, if that was the case, there'd be a lot of Canadians talking about this. So you can probably tell that it's a little bit better being a resident of Canada. We are entitled under the Canada-US Tax Treaty to what they refer to as an enhanced exemption. And the exemption is the US estate tax unified credit. Moment with Trump tax reform is actually just over $12 million. It's $12,060,000 that a US person can have before they are exposed to estate tax. However, there's a prorated formula. So you have to multiply that credit by the value of the US situs assets that you hold divided by the value of your worldwide assets. And so in 2022, if that's 12,060 is the number, you have to prorate that by the percentage essentially of US situs assets that you hold. So moving on to the next slide, that sounds like a big exemption. And so, a lot of you might be breathing a sigh of relief. That could change, and it has changed historically, and that's why it's still a very important consideration to bear in mind. So one example here is the Biden administration during their campaign, return to what they referred to as 2009 levels for the US estate tax exemption. And what that would essentially do is it would take the $12 million exemption that existed under Trump tax reform, and it would bring it down to $3.5 million as you can probably imagine, if you start, the amount of US situs assets you can have would be significantly lower. Another risk that's noted on this slide is that Trump tax reform actually intentionally built in a sunset clause in their $12 million amount, and said that the exemption that they had brought into law was going to automatically expire on January 1st, 2026. And so what that means is that unless the administration that's in power on January 1st, 2026 passes legislation, the will automatically fall to about $6 million from the $12 million that it is today. And so there are some risks here that it could go to 6 million, it could go to 3.5 million, as opposed to just being this big number that we're currently looking at. So if we go to the next slide, let's stress test this number a little bit. So let's just assume you have total worldwide assets of $5 million. You have a Florida condo, it's worth $750,000. And let's say that you have stock in US companies of about $1 million. So your Apple stock, your GE, all of that sitting in your brokerage account is worth about 1 million US. So the question is, with today's exemption amount, are you exposed to estate tax? Let's run the numbers. So the US estate tax unified credit is the value of US situs is going to be 12,060. And then you can see here that in the example, we have a $750,000 condo and we have $1 million worth of stock, over $5 million in total assets, which means the exemption amount that we are entitled to today is $4,221,000. And so if the total assets that we have that are US situs are the 750K condo and the 1 million in stock, we are under state tax today. But let's go to the next example, stress tested under the worst case scenario. Let's say that the Biden administration decides to follow through with what they were talking about with a return to a $3.5 million exemption. Well, at that point, we have a $750,000 condo, $1 million in stock, $5 million in total assets. It means that our total exemption amount would be $1,225,000 than the $1,750,000 worth of U.S. situs assets that we have today. So that reduction would result in exposure to estate tax at the prescribed rates. So essentially, the slide kind of speaks to it for itself, but it means that this would be an issue for a U.S. taxpayer. So estate tax is something that it's a good idea to be following along on what changes are occurring with respect to the worldwide exemption.
Andrew, it's kind of just a lot of questions about the denomination of the values that you're using. Is that all in US dollars?
Yeah, that's so essentially we have to keep all the denominations the same. So you could do the formula. Essentially, if you do so maybe just to back up to the previous slide and let's go one more back. Yep. So in this particular case, if we're going to have the condo, the stock, and total assets all in Canadian dollars, the formula will work. But likewise, if you have the condo, the stock, and the total assets in US dollars, the formula will also work. So we have to make sure that we have everything in that part of the formula in the same currency. Okay, so let's skip ahead a couple. So let's just stop here for 1 second. So strategies to mitigate. One thing that's nice for non-residents of the United States, so if you're a U.S. citizen or you're U.S. domiciled, these strategies won't necessarily get you to a better position. But if you're a Canadian resident, Canadian domiciled, non-U.S. citizen, one thing that you can do is you can make lifetime gifts. The U.S. has a gift tax, but in many respects, with proper planning, it doesn't apply to purely Canadian residents. And so gifting property to family members prior to death is one way to get your U.S. tax liability under the threshold. Another thing that you can look at is trust structures put in place in an appropriate way. That can be something that can mitigate the impact of U.S. estate tax. And there are also complex structuring that can be used if you already own the assets that you're proposing to purchase. One of them involves a limited partnership, and there are some other things that can be considered to shield property from U.S. estate tax. Now, going on to the next slide. How likely is the proposed change? I thought it might be interesting to just kind of put up a bit of a brief history here. 2001, it was pretty low. The estate tax exclusion for a U.S. citizen was only $675,000 before he started paying estate tax, and the top rate at the time, believe it or not, was 55% of the fair market value of your assets. So it was more than half of your estate would go to the IRS at the time of death. During the Bush administration, you can see that it drastically increased. So it went from 1 million to 1.5 to 2 to 3.5. And then in the final year of the Bush administration, I believe it was 2009, as part of as sort of a parting gift, the administration actually had the estate tax completely repealed during several months in 2010. Now the Obama administration was elected at that time, and they chose to bring the estate tax back, but they decided to maintain the exemption amount of $5 million and to increase it basically at inflation. And so that's why instead of it going up, 1 million, 2 million, 5 million, it goes up 5 million to 5.12 million, 5.25, as that's the inflationary adjustment that the Obama administration chose to use. And then it was the Trump administration that doubled it from 5.4 to 18 million. And then since then, it's been increasing essentially with inflation. So for the future, could be 3.5, could be 6, or it could be 12. It really depends on what the administration decides to do. But this really does show that it is a moving target. And so essentially, that's we can skip this slide as well. And so at this point, there are some examples of gifting property to family members is a very good way to deal with U.S. estate tax. So basically what that means is that there are certain types of property that you can gift to family members without incurring a gift tax if you're a non-resident of the United States. So what that means is, as well as you can actually lock in, even if you are a U.S. citizen, you can lock in a lower value for the value of the gift and what gets counted toward your taxable estate, and allow the future generation to start accumulating the increase in value that those assets have. But the only catch to that is, especially if we're dealing with Canadian rules, if you're gifting U.S. stock to a family member that's also a Canadian resident, in certain circumstances, you may be running into what we refer to as the attribution rules, which may require you to pick up the tax on your own tax return, even though you've gifted the value of the property to somebody else. So it's an important consideration. So essentially, this is a good final point to make, and that is really just talking a little bit about real estate prices and tax strategy. And so one of the final iterations that's really interesting to consider this year is basically that up until now, when people own multiple properties, when it's real estate, the assumption has always been that if you own a house in Toronto or Vancouver, that's going to be the property that really increases in value more than your cottage or your condo or anything else that you own. However, what we're seeing with the pandemic is that really hasn't been true. I'm speaking from more of a Torontonian perspective, I guess, right now, but we've had the slowest growth in all of Ontario in our real property, and it's been the smaller markets like the Kingstons and cottage country that have really seen a lot of growth over the course of options on where to live. And so what that means is it really is important to look at one of the assumptions that a lot of us have carried for the last little while, which is that when we get to use the principal residence exemption, the principal residence exemption allows you to exempt one property's capital appreciation from a taxable capital gain in Canada. It may no longer be your Toronto house or your Vancouver house that is going to have the most capital appreciation, and you get more bang from your buck on looking at some of your secondary properties and saying, how much have they appreciated? Do I need to do any planning to try to lock in a gain on one of these properties and use my principal residence exemption most efficiently? So obviously we don't have a lot of time to dive into this, but what I would recommend is that if you own multiple properties, have a look at how you plan to use the principal exemption, and we can. It's always something that a tax advisor can help you determine if there's an optimal strategy there.
All right. Well, we don't have a lot of time left, but let's jump to the tax chat slide. Fabio? One more. Yeah. So we do have an on-demand mobile tax preparation service. It's an app that, for those of you that like doing your own tax returns, this is a good way, instead of buying the software, to potentially use this service. To be able to check out the website. It'll give you the pricing, etc. We have 12 minutes because I know there's lots of questions. So Lisa, I'll hand it over to you.
Thanks, Ken, and thanks to all of you, Ken, Wesley, and Andrew, for sharing your valuable insights. As you can see, tax planning has many intricacies and opportunities. And as stuntmen often say in the movies, don't try this at home, folks. And this is exactly why HSBC has partnered with EY, a global firm that provides tax planning, is a tax planning partner who can support you. So with that, we'd like to take an opportunity to head into question and answers. As reminded, there is a Q&A button at the bottom of your screen. Feel free to type in your questions, and we'll do our best to answer everyone. But as always, just want to stress to you all, based on timing, we may not get to everyone's, and obviously recommend you going back to your relationship manager, and feel free to share your questions with them, and they will raise accordingly as well, or be connected with the right connection. So with that, I'm going to start with a general question and throw it over to perhaps Ken or Wes. Is the capital gain exemption only applicable to CCPC shares or Canadian controlled private corporation shares?
Yes. So the capital gains exemption is not only do the shares have to be directly owned by the individual that wants to claim the capital gains exemption, but it has to be a Canadian controlled private corporation that meets the definition. That's a corporation that's not controlled by either non-resident corporations. And there's another test that I mentioned before, that the tests relating to qualification have to do with whether the company is the fair market value of the company is in an active business. So if you own shares of a company that's Canadian controlled, but it's all passive investments, then that doesn't qualify as well. That's just a quick, the rules are very specific. I don't have time for all the details, but that's how those rules work.
Perfect. Thanks, Ken. For our next question, again, this is going to be tied to tax and investing. So Ken and Wesley, I think you're up again. For the purpose of investing in a corporation, is it better to invest under corporate title or a numbered company, a separate numbered company?
Yeah, start and you can jump in, but again, I'm not sure if that question relates to if there's an investment opportunity and you have the ability to get into this opportunity either through a numbered company or personally. I think there's a couple of things to think about. One, if the shares could qualify for the capital gains exemption, then you're better off holding it personally. So a lot of clients, when they call us about investment opportunities, that's the first question, because that's a big exemption. The second question is now looking at, is there a tax advantage to holding investments in a corporation? And the answer depends, right? The government has done, set it up the tax system in such a way that an advantage to holding investments through a corporation. And if you actually want to enjoy that income personally, there's actually a tax cost to holding passive investments in a corporation. But if you're okay to leave that in the corporation, there may be a very small deferral. Again, looking at tax rates at the high rate, a corporation that earning passive income, that tax is taxed around 50%. But in Ontario, that tax, if you were earning that investment income, let's say interest income personally, it would be taxed at 53%, again, assuming the highest rate. So there really isn't a huge advantage to owning it in the corporation. But if you actually distribute that cash out of the corporation, there's a tax cost. So these are all things that you have to kind of do the number crunching. I don't know, Wesley, if you had anything else to add to that.
Yeah, I mean, just if it's the kind of investment you're going to be a substantial owner, where say you're going to own shares of a corporation where you'll have more than 10% of the equity, the total equity of the company, and more than 10% of the votes of that company, then dividend distributions could move up to own holding company, effectively tax-free. And so if you're in that kind of position where it's a substantial investment, you might be better off, you'd likely be better off with a holding company. But for most investments, it's exactly what Ken said. It depends.
Perfect. Throw in real estate properties. Should this be better served in structuring under personal names or a holding company?
Ken, I'm happy to start off with that one. You can jump in. This is another it depends. That same deferral, that slight deferral that Ken mentioned, might be available where, say, on rental income or capital gains, maybe could potentially be a little bit lower than the personal tax rate. But then again, there could be that tax cost if you need the funds personally, where it becomes really sticky and a challenge on real estate to own it in a company is if it's going to be mixed, let's call it business use and personal use. So you'll rent it out, but you'll also use it part of the time, like a vacation property. In that case, personal use of a property that's owned by a corporation, taxable benefit in Canada, and it can be very difficult to manage that. So if you think you're going to be using a property personally, we can look at it, but usually you'll be better off having it owned personally. Ken, tell to what you might say.
Yeah, the only thing to add to that is that it might be legal protection that you're interested in, and therefore that's one reason why you want to potentially have it in a corporation. In my experience, I think depending on the value, depending on how much rental properties you're acquiring, it may make sense to have that action as well.
hopefully.
Perfect. Thanks, gentlemen. And one more time, I'm going to put both of you on the spot, and then I'm actually going to chat one of our questions. So tied to investment property that's in personal name that you're transferring to a corporation, what's the tax implications there in general? So again, go ahead.
So generally transferring an asset, any asset, to another entity, whether it's corporation, trust, what have you, the default rule is that it's a taxable transaction. In the case of capital property, it's transferred to a corporation, you are able to potentially defer that tax in a situation like I described in the estate freeze. And it does require some added steps. You have to file an election with CRA, you have to disclose the transfer, and you can only you have to take back shares of the company. You're limited in any kind of cash or other consideration you might take back from the company, but there is a potential to avoid tax when you transfer assets into a company. Important exclusions from that: real estate land transfer tax still apply, especially in Ontario. There's generally no exemption from land transfer tax if you transfer real estate into a holding company, and if it's real, especially if it's real estate that is inventory. So if you're talking about like condo development, you also can't do a rollover into a corporation in that circumstance.
As Wesley mentioned, if you meet the criteria, you can roll the property into a corporation tax-free. Real estate out of the corporation tax-free. And that's something that is, just to think about, right? Because, if you do have some capital losses personally, now that capital gain in the future of the real estate will be taxed in that corporation, and you can't use those capital losses. So think about when transferring to a corporation.
Perfect. I think we have time for one more question. And Andrew, I'm going to put you on the spot and see how concise you can be with this answer as well for us. So one of our guests has posed this question. In my RRSP and TFSA, I invest in Canadian index funds, some of which are based on overseas indexes, i.e. Dow Jones indices. Is this based on your comment about avoiding overseas income stocks in RRSPs/TFSAs?
That's the answer is, well, I don't want to say it depends, because we're already making fun of how we're answering like that. But what you need to look at to decide if that's going to be optimal planning or not is you have to pull your transaction statements, and you have to take a look to see if you are getting non-resident tax withheld. If you are getting non-resident tax withheld, it's flagged a decision point in your portfolio. And the decision point is there some other asset generating Canadian sources of income or generating any dividend income that I can swap out of a non-registered account and trade those two securities so that I'm getting the tax credit that comes from the dividend income that's being paid. So hopefully that helps answer the question.
You did fabulous. Fantastic. We'll get some feedback from our guest, their post, hopefully. So with that, I just wanted to say thank you to everybody for giving us their time to spend today. Hopefully you've gained some valuable insights from our panelists, really here at HSBC and via our partners with EY. We hope to support you in any way in terms of providing resource information for your tax planning. As you'll see on the screen, we want to highlight the three partners and panelists who joined us here today. Ken Kiriakou and Ken's contact info, Wesley Isaacs, and Andrew Stevens. And what I also want to reiterate to everybody, again, there are various intricacies and opportunities through tax planning. And it is so very important, whether it be tax related for you and your family, or whether it be estate planning, both domestically and cross-border, you need to seek the advice of people like Ken, Andrew, and Wesley, who can make sure that they structure your planning appropriately. And As a final note, I encourage you post this webinar. I know there's a lot of questions. Thank you very much for all your interest. Please reach out to your respective relationship managers for further support. They will ensure to speak more about your tax planning concerns, and where appropriate, connect you to our partners from there. So with that, I just want to say thank you to all for joining us. Stay safe and be well. Thank you.